Welcome back to the Sense of Security podcast. I'm Cassidy Clement, Senior Manager of SEO and Content at Interactive Brokers. And today I'm your host for the podcast. Our guest is Steve Sosnick, Chief Strategist at Interactive Brokers. Consumer sentiment is a very popular topic when we look at a company, an investment, or even the economy. So, how much does it matter when reviewing someone's financial state? Are there certain additional factors? In this episode, we're going to discuss all of that and more. Welcome back to the program, Steve.
Hey, Cassidy, great to see you again.
So you write about this every day, almost every business day on Traders Insight about consumer sentiment impacting the market and the different ups and downs that we see. It's a very hot topic nowadays. There's so much question around what's the market going to do today. It doesn't seem as same thing, different day as it did for a while. So, what exactly is consumer sentiment and why are we hearing so much about it as of late?
This is one of the things that's been plaguing me for the last few months is there are various consumer sentiment measures. And two of the more popular ones come from the University of Michigan and from the Conference Board. The University of Michigan numbers come out every 2 weeks. The Conference Board tends to come out once a month. And about 6 weeks ago, I started to notice what I saw as a bit of a problem in the University of Michigan numbers. And that was the consumer sentiment had been dipping, but inflationary expectations out of the blue zoomed. Among the questions they ask are just your general sentiment, your expectations, but also your expectations for 1 year inflation and 5 year inflation. And the 1 year inflationary expectations out of nowhere it went from 3.3 to about 4.3, which is not what we're expecting. And normally those numbers can be a bit volatile, but they almost always move with the price of gasoline at the pump, quite frankly. But yet gasoline hadn't really changed very much, not enough to accommodate that. And so I took that as a bit of a weird yellow flag. Then the numbers came out from the subsequent numbers that came out from Michigan and the conference board were sort of way below economists' expectations. They were surprisingly bad. And it's a little tough to draw conclusions from it. I have to take my read from the people who put those numbers together. But basically, it appears that tariff fears were affecting inflationary concerns. And I think just the uncertainty brought about by Doge and by, again, the potential for tariffs and the new administration, that sort of sent consumer sentiment reeling. Then let me say it differently. One of the other things that you have here is the surveys tell you what people intend to do. It's also more helpful to look at what people are actually doing. It's one thing to say what you're going to do. Yeah, I'm going to lose 15 pounds over the rest of the year. I say that every year. But so my intentions may or may not change regarding what I intend to do about my weight or my personal health. But in reality, it's do I go buy another box of cookies or not? But what also we saw around the same time was the government compiled retail sales numbers plunged pretty much unexpected. So not only had sentiment changed, but their activity changed. And then a couple of days after the retail sales numbers from the government came out, Walmart gave a warning about future guidance. And forget what the government's saying. You may or may not like it. Forget what some independent surveys are saying. Michigan Conference Board, you may or may not like it. If Walmart is telling you that customers are not spending as freely as they were, that is about as good of an indication as you could possibly get. And that is where I think a lot of the concerns about consumer sentiment really came to the forefront.
When we think about the consumer sentiment as a metric, usually it's okay, how optimistic is the general public? And that's going to stem from, as you said, maybe their actual spending habits or the economic output of the country or some public or economic policies that are coming in. Are they actually scaring people for saving or are they just brushing it off and still spending? When we get into the actual metric, though, you had mentioned Michigan earlier with a place that puts out an actual number for this metric, but how is it usually measured?
This is survey data. And I got to admit, I'm not super expert in exactly what, when you see a reading from Michigan and the last number, pardon me for looking at my other screen, because that's where they are. The last Michigan sentiment number was 63, it was 64.7. And this next reading is supposed to be 63.1. I got to admit, I'm not quite sure how they differ from each other. But as with most things market related, I think it was John Maynard Keynes who said that the object of investors is not to pick who the winner of the beauty contest is. It's who the market thinks will be the winner of the beauty contest will be. And so in this case, it's less a matter of, I don't, it's less important to know because I'm able to function just fine by not knowing exactly how they arrive at 64.7. But I can tell you that if it's 63.1, that's worse than it was last reading. And if that number comes out below 63.1 or above 63.1, that's a positive or negative surprise. The other numbers are more straightforward. In the case of inflationary expectations, it's a percentage. So it's basically right now, the last reading was for 1 year inflation, the expectation is 4.3%. That, that is what it is. That's a pretty straightforward number. Prices are expected to be 4.3% higher on average than they are now 1 year from now.
The actual drivers that go into a market viewpoint when coupled with success, at least that I have found in my research and in several years of being in the business and also reading your articles. There's a lot of elements that get coupled with it. Maybe it's employment. You mentioned inflation, interest, and wage growth. All of that comes together and sometimes will be a almost a partner in conversation when people talk about consumer sentiment. What exactly is the defining element, I guess you could say, of why people move or talk about consumer sentiment and these other elements together? Why is that? Is there a certain type of movement that they correlate? Or is it more so that, okay, they're all part of the consumer life? Your wage is going to impact how much you spend, etc.
I think to some extent, and this is not meant as a cop out, a little bit of all of that, because it's very complicated. Anyone who's listening, or I'll ask you the question, what influences your mood? A lot of things. Yeah, it's how you feel about your job or your friends, your neighbors, your contacts. How are they feeling about their jobs? How much are things costing you? That's why I said the inflationary expectations tend to follow the price of gasoline because it's something that everybody, I mean, you don't drive an electric car, but if you drive an internal combustion car, like most people still do, you have to fill up your tank periodically. And you know if that's getting more or less expensive. And unlike most other prices, as you drive down the road, the price of gasoline stares you in the face, right? It's 3.19 at this station, it's 2.97 at this station, blah blah blah. So you have a sense of that. So that's why that number is correlated. But in a general sense, it is all those things. It's how do you feel about your own job prospects? That are you hearing of layoffs amongst your friends or relatives or other contacts? That affects things. There is some reflexivity with the stock market. Are stocks doing well? That people feel better. There's a well-known thing called the wealth effect. And quite frankly, people, when stocks are going up, people feel wealthier. Other stuff could also just an individual consumer, just did you have a bad day at work? Did your spouse yell at you? That kind of thing. Those are the other parts of sentiment. But obviously those fall in the wash when you survey enough people. But these are the real drivers. And the thing that's very important, and the reason I find it really crucial is the consumer spending is about two-thirds of the economy. And so if consumers are fairly rosy minded, that will help GDP, that will help the economy, and that has multiplier effects. If you spend money in one business, then those people have more money to spend somewhere else, et cetera, et cetera. And it's a very basic economic equation that people should just know this. It's from economics. Let's see if you remember your Econ 101, Cassidy, is GDP equals C plus I plus G plus NX. And that's the C is for consumer, the I is for investment, the G is for government, and the NX is net exports. It exports less imports. So if C is really two-thirds of the equation, anything that it makes C go up and down is going to have a fairly profound impact on the rest of the equation. But again, these are not things in isolation. One of the things that where it's believed that Doge is having an effect is the stated intent of the Doge program is to reduce the size of G. Now, it's one thing to reduce the size of G, so that will probably have some negative effects on GDP when those numbers come out. But what it also means is in the meantime, by doing it via a lot of layoffs, not all federal government jobs are in Washington. Federal government jobs are everywhere. And so remember what I said about, are you hearing about your neighbors losing their job or something of that nature? So if these job cuts, they're not huge across the board. And so they may not show up. They didn't show up in unemployment numbers in the last reading yet. And it's not clear that they're going to show up in a meaningful way. But what it does mean is if you're hearing overall about a lot of people with solid, good jobs that they've been relying upon dispersed around the country, and they're losing them, that has a negative impact on consumer sentiment. And that then the drawdown in G also has an effect on C. And we can argue whether the tariffs are going to produce enough of NX to offset that. But again, in the short term, that's not helping consumer sentiment. So you're getting the drawdown in C before we really see any effects on the NX part of the equation. So it's a fairly simple mathematical equation, but it's got very profound effects on the economy.
You brought up such a great point. I have been in many conversations where I'd love to pull out the whiteboard and go over that one because they all rely on each other. They're all pillars within this pavilion that makes up this one item, like you
Yeah.
said, GDP. And if C is two-thirds of the whole, but it's impacted by G, and then if NX is imported, it's impacted by tariffs, which then can impact I, your entire formula can be completely derailed from any other trend that you've had. And I think you led me perfect into my next question, which is we see consumer sentiment impact a company or a sector pretty directly. Something easy is okay. Back in the day, people would go to Blockbuster and rent videos, and that was such a big deal. And that was your Friday. You go out, grab a bag of gummy worms, get your video, go home and watch it. As the sentiment changed, and users said, "Why would I be doing that? I can," at one point, Netflix by mail, if you recall those days, and or now I'm streaming things. I don't need to go buy physical copies. The sentiment towards that sector was, or that company or that business model was, I don't really need that anymore. So it impacted people's jobs, it impacted those companies. But when we look at it from a broader perspective, how does consumer sentiment impact the economy as a whole? And I know there's many historical examples, but if you could give one or maybe a hypothetical for our listeners, I think it'll be really advantageous because we're currently in a economic state where
Mhm.
people have all types of opinion, but the market is acting very unsure.
That's why I harped on the Walmart example before, because so much Walmart, it's Walmart and Amazon are almost a duopoly here, but Walmart is probably a bit more of a constructive example because you almost everybody turns up at Walmart at some point. And they do. And one of the things that Walmart talks about is a lot of times when there's an initial slowdown in the economy, they benefit. And you may say, why? Because people can, wait a minute, people can't spend more money if the economy's slowing down. Here's the thing, if unemployment goes from 4 to 5%, that's terrible in this environment right now. But what it still means is 95% of the people who want jobs have them. So it still means those people have to spend money, but they're going to spend a little less. They may switch to house brands as opposed to luxury, as opposed to national brands. While consumer staples tend to do well because ultimately you still need products from Colgate Palmolive and Procter and Gamble, their ability to pass on price increases, their share of the market might decrease a little bit and may spill back on them. And so people might be buying the Walmart house brand. Another thing they talk about sometimes is the higher income consumers, when things get a little rocky, they turn up at Walmart more than they might when things are going well. So what ends up happening is that they'll mention that we got a higher percent, things are a little dodgy out there. So we got a higher percentage of 6-figure income shoppers this month or this quarter because those people are becoming a little more value oriented. You know what? We've been going to Target. It's a little bit nicer store, but the prices tend to be a little bit better in Walmart. And so let's go there instead. So these are a lot of little micro interactions, but I've just thrown out some pretty important companies in this whole discussion. Or, you get to Walmart and it's a family with kids and the kids have the gimmies and, you know, if you have a little extra income in your pockets and you're feeling good, yeah, you're more likely to say yes than if you're truly strapped and you have to say no. And so these are all the different things. These are all the very subtle ways that consumer sentiment plays in. Are you going to shop for a new house if you're feeling tenuous about your job? Are you going to shop for a new car if you're feeling tenuous about your job or interest rates? Or things of or just the price or just that prices are going up, and so the car payment that I thought I could afford last month might not seem as affordable this month. There's a zillion different decisions that we all make in any given day, and a lot of that depends it depends first and foremost on your direct prospects for income and things of that nature, but a secondary order thing is just I don't know. I'm feeling a little nervous. Maybe now is not the time to make a major purchase. Maybe we can get another couple of months out of this old washing machine rather than buying a new one. That kind of thing.
Yeah, that's definitely, I think, a common phrase that I'm hearing in my life and also throughout the news. A lot of people saying, I got to make things work for longer than I expected, whether it's the car, the lawnmower, now that it's starting to get nicer out on the East Coast, things of that nature. The big purchases are getting pushed back a little bit until people have a little bit more certainty. But when we're talking about consumer sentiment and uncertainty and people saying, I have financial goals I still want to attain. And some people may be close to retirement. Some people may just be starting full time employment. What are some things to keep in mind when you're utilizing consumer sentiment as part of your financial strategy? Because someone might say, what's consumer sentiment? Like, how much does it actually matter when my financial goal is blank many years down the road or something like that?
Again, this is more the short term. Over time, it's very difficult to bet against American companies. It's very difficult to bet against the American consumer. We've shown through hell or high water that we're going to go spend money if we can. And a lot of times if we feel and honestly, you've heard the term retail therapy. There are people who spend money even when they probably shouldn't. And so but these are the type of considerations. So it's not necessarily this is more, I would say, from a market's point of view, it's more of a short to midterm type of thing. It's not necessarily so if Kimberly Clark has a bad quarter because people switched from the upscale toilet paper to the more generic toilet paper, that's not necessarily going to affect your investments over the coming 20 years. It's going to affect if you own that specific stock this quarter, but it's a different problem. But it's also important to know from a personal point of view of everything. There's a market for everything out there. So perhaps sometimes maybe if you're in a good financial situation, but you feel that consumer sentiment is getting a little weaker, maybe you do want to hold off on buying that car because car dealers might be there might be specials, there might be sales on that car, $2,000 rebate next month or 2 months from now because they're not moving off the lots. So this is the way you utilize it. I do think it's really where this is actually where personal finance intersects with the markets. But I think it's much more important to always to keep your personal finances first and the market impacts second in this situation. But on the other hand, can give you insights to where the market might go and trends therein. By the way, one thing I didn't mention when I was talking about the consumer sentiment numbers is very unusually, and this is very much a product of our times, they reflected political leanings. So prior to the election, Republicans polled worse than Democrats, and independents were in the middle. After the election, and certainly once a lot of the tariff talk came into play, those numbers more or less reversed. So Republicans feel much better about the economy, and Democrats feel much worse. The problem is independents, which were even keeled before, have tended to start to move with the Democrats a little bit, meaning that while there was a political effect in the numbers, it's also affecting people who may or may not view life through a political lens.
Yeah, it's important to always remember that when you are looking at any type of economic metric, you don't want to look at it in a vacuum or in isolation because there are several different caveats. And then there's also the idea of we'll say anomalies or major changes. An election's a good example, a natural disaster is another one, a global pandemic is another. There's so many elements that can go into a immediate pivot when we're actually going through readings or new numbers that get published. There's so many other multitudes of data out there that you can look at to try to make sense of these trends. Before we close this out, is there anything from your perspective that you can say down the line, I'm going to be looking at consumer sentiment in terms of X over the next couple of months? As we're recording this in mid March, the market's got a lot of uncertainty.
And well, interestingly, and I wrote a piece about this recently, mid-March can be a very weird, auspicious time for markets. That's literally was the peak of the internet bubble. It's as we're taping this, I think it's literally 5 years to the day from when the COVID pandemic was declared. And the markets bottomed. They plunged around this time. And then a couple weeks later, they started to find the bottom when the Fed came in full blast. 2 years ago, roughly this time was the Silicon Valley banking crisis. The piece
I
was called
love
Beware.
a millennial.
Yeah,
I
well,
remember all of these vividly.
yes. So the title of the piece was "Beware the Ides of March" because it's just I don't know. That's a whole other podcast about statistical oddities like that. But in terms of what I'm looking for going forward, does the consumer continue to get worse? Does it stabilize? And does it stabilize at lower levels? And does it start to turn around? I think right now, considering the mood in this, as we're taping this, the mood in the stock market is pretty miserable. I think a lot of people are getting nervous about that, and at least for those who have the resources and have been investing, which I believe is a good piece of our audience, there's probably some angst among that, which is not helping sentiment. All things being equal, with the markets down 10%, presumably you're 10% less wealthy on paper. Let me just say that very carefully on paper than you were. And while that shouldn't necessarily, especially if you're looking at retirement accounts, it shouldn't necessarily change your opinion. It does. It's human nature. And we have no clarity as of yet about tariffs and how that might affect prices. And so I'm going to be looking very carefully at these numbers and listening to what some of the retailers are saying about what consumers are doing. And I think you watch, as I mentioned, the Michigan numbers, watch the consumer confidence number, the Conference Board's consumer confidence numbers, watch broadly the retail sales report from the Bureau of Labor Statistics, and listen to what Walmart, Target, Amazon, and some of these others are saying about customers. Yesterday, again, I'm taping this March 12th, there was some bad news out of Dick's Sporting Goods and Kohl's. Those could be maybe a bit more niche companies. Kohl's has its own issues. And on Dick's Sporting Goods, you know what? You're still going to buy shin guards for the kid. Again, you're going to still buy shin guards for the kids to play soccer or baseball mitt this time of year. That's one of the last things you're going to give up on. But maybe you don't buy a new maybe you don't buy a new set of golf clubs or that kind of thing. So these are all these discretionary items in there. And so though you have to listen for the clues from consumer goods companies. Also, although I'm not a huge fan of over listening to bank earnings, and we're about a month away from those, listen to what they say about consumers when they start to talk about it. Are they seeing more delinquencies? Are people having problems paying back their car loans they seeing credit card spending go up maybe faster than incomes because that means people are going into debt to do their shopping. These little things you should be looking for. Again, I wouldn't necessarily I wouldn't make long-term decisions based on any one of these numbers. But I think in terms of having a sense for the short to medium term about where the economy is going, if you have a good sense of where the consumer is going, you got a good sense of where 2/3 of the economy is going.
Yeah, since that makes up such a large part of the spending aspect, I know that gets to be a concern. Before we wrap up, I just have a question to tie this with a bow. I know this is such a larger discussion, but as we are entering mid March, there has been a lot of layoffs from the federal government and private companies. How exactly would that impact consumer sentiment and our output economically if, in a way, our job market starts to become a little bit more flooded? I'm just interested in how a lot of these companies are reacting because when we've woken up the past week or so, it's been consistent red with the keywords of layoffs and tariffs in most of the headlines. And I know that can spook people in terms of consumer sentiment, but I'm just curious how that works economically because this is probably the first time in my lifetime that I've seen it at this scale.
Well, there's an old saying, and that is, the definition of a recession is when your friend or neighbor loses their job. And the definition of a depression is when you lose yours. And so that's an important thing. If you're hearing that the job market isn't good, well, you may tighten up because you get nervous about your own job prospects. You get nervous about your prospects for a raise or a bonus, or you get nervous about your ability to just maintain your lifestyle. So it's natural for people to pull back. And I think because human beings are dealing off a lot of anecdotal evidence and view the world around them, it's just human nature. If you're hearing about, oh, Jane down the street worked for the federal government for the last 22 years, and then all of a sudden she cleaned out her desk one afternoon. Does it affect your life directly? No. Does it affect your sentiment? Probably. And so this is where it becomes a bit difficult to deal with. And that's where not harped, but wanted to bring about the distinction between survey data, which is a lot about vibes, and the actual number and the actual spending, which is about what's going on. Sometimes the two don't necessarily follow each other. In this case, lately, at least last month, last quarter, they have, and which makes me a little which made me a little more concerned. And I hope we'll link some of the stuff I've written in here, but which started to get me concerned about this stuff a couple weeks ago, a couple months, about a month or two ago, that this was going on. So this is the issue there's the economics, and you could say, okay, if X number of people lose their jobs and that's X number of, you could go through the C and the I and the G and see how that all impacts things. But in terms of where the sentiment comes in, it's just off of all the stuff we listen to and react to on a daily basis. And this is where it's a collection of 350 million people's individual experiences and individual attitudes operating collectively. That's a pretty difficult thing to model.
Yeah, the element of psychology and behavioral finance is probably the most important ancillary item here to consumer sentiment because that plays so much in part with it. But you brought up some awesome points today. Thanks for joining us, Steve.
My pleasure, Cassidy. Look forward to doing with you again soon.
Yeah, thanks for joining us. So, as always, listeners can learn more about an array of financial topics for free at interactivebrokers.com/campus. Follow us on your favorite podcast network and feel free to leave us a rating or review. Thanks for listening, everyone.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice.